Hello everyone, my name is Alia Kansardelia, and in this opportunity, I will present my integrated corporate finance analysis of PT Kalbe Pharma, one of Indonesia's leading pharmaceutical and healthcare companies. Kalbe was established in 1966 and has grown into a healthcare conglomerate with four business segments: prescription drugs, health products, consumer health, nutrition, distribution, and logistics. The most important point from this slide is that Kalbe is not dependent on only one product. It has diversified healthcare platform which helps the company maintain defensive growth. The prescription segment is the largest contributor in the model, with approximately 13.95 trillion or 50.6% of the segmental contribution base. So, Kalbe's strength comes from its integrated healthcare model. However, its future value will depend on how well the company can protect margins and execute regional expansion. Indonesia's pharmaceutical industry remains attractive because of several drivers, such as a large population and rising health awareness. But the biggest challenge is pricing power. BPJS Kesehatan dan public procurement mechanism limit the ability of pharmaceutical companies to increase their prices, especially for essential medicines. This is reflected in the company's margin trend. Kalbe's gross margin declined in 2021 to 38.8% in 2023, before recovering to 39.7% in 2024 and 39.7% in 2025. This is Kalbe's income statement, balance sheet, cash flow, and financial ratios. I will highlight only the most important points. From the income statement, Kalbe shows steady historical growth. Revenue increased in 2023 to 35.32 trillion in 2025. There is an improvement as well in net income. In terms of profitability, gross margin recovered in 2025. ROE and ROA also increased. This shows that Kalbe can still generate returns even with a very low leverage. The balance sheet is also conservative. Debt to equity was only 0.00 in 2025. However, working capital still needs attention. The model targets DSO of which are important to improve the cash conversion cycle. Overall, Kalbe is financially healthy, but its future cash flow quality will depend on margin control and working capital efficiency. The standard MPV is not enough to evaluate the LPI joint venture. Instead, the most relevant real option here is the deferral option, which means Kalbe has the option to delay the factory capacity investment for 1 year. This gives the company time to observe the API market demand, technology transfer, progress from leaf zone, BPOM validation costs, and environmental compliance readiness. The Meritor model is also used to assess structural risk. The model treats equity as a call option to firm value. It should be read as a stress-based structural risk indicator. The Black-Scholes also calculation give a real option value of 2.95 trillion for the total project. The main takeaway is that managerial flexibility significantly increases the strategic value of the LPI project. Kalbe has an equity-heavy capital structure. In 2025, total equity reached 24.73 trillion, while long-term borrowings were only 145 billion. This resulted in a very low debt-to-equity ratio of 0.006. This conservative structure gives the Kalbe strong financial flexibility. However, from a corporate finance perspective, being too conservative also creates an opportunity cost. My recommendation is that Kalbe should maintain a conservative capital structure, but a low debt weight of around 8 to 12% for assets with clear cash flow visibility. For the LPI project, early stage funding should still come from retained earnings and internal cash. Debt financing should only be used once the project has clear off-take agreements and proven unit economics. This valuation analysis using three methods: DCF, multi-stage DDM, and relative valuation, and resulting in a final weighted average cost of capital of 9.7%. The normalized DCF based from the football field analysis gives a fair value of 1,580 IDR per share, while the DDM is 1,450 IDR per share. The main conclusion is that Kalbe has upside if margins normalize, with a defensible value range and per share. However, if the 74.5% cause of growth scenario persists, downside risk becomes material. Kalbe has a strong reputation as a defensive dividend-paying company. The long-term policy used in the model is 55% payout ratio. This dividend policy is important because investors often see Kalbe as a defensive healthcare stock. A stable dividend policy signals earnings quality, stable cash flow, and management discipline. However, Kalbe also needs to retain enough earnings to fund their expansion. The ASEAN GV investment requirement of 325 billion is also relatively manageable compared to Kalbe's retained earnings. My recommendation is to maintain a 55% payout ratio under the base case, but allow flexibility to reduce the payout to 45 and 50% if margins come under pressure or if the LPI project needs additional capital. Focuses on PT Livzon Pharma Indonesia, or LPI. LPI is a joint venture between GCM within the Kalbe ecosystem and Lian SGP Holding, or Livzon Group. The total initial project investment is 50 billion. Strategically, LPI addresses three key issues: imported API dependency, the need for upstream supply chain integration, and ASEAN market expansion. The standalone target NPV is 369.30 billion, while synergy value reaches 1.8 trillion. Therefore, LPI is financially attractive, but it should be executed using a phase-gate approach with clear milestones for permits, technical validation, offtake agreements, ESG readiness, and positive unit economics. Since Kalbe operates in the pharmaceutical sector, ESG is not only about reputation, it directly affects operating risk, regulatory risk, cost of capital, and long-term cash flow. From the environmental side, Kalbe has a 30% emissions reduction target equivalent to 7,000 tons of carbon dioxide. From the social side, Kalbe contributes to healthcare access through approximately 17,000 employees, 71 distribution branches, 14 production facilities, and a network reaching more than 1 million outlets. CSR spending also increased from 13 billion in 2022 to 24 billion in 2024. This makes transparency and governance especially important, particularly for the LPI joint venture. To conclude, Kalbe is a fundamentally strong company with a defensive business model, recovering margins, strong ROE and ROA, very low leverage. The DCF valuation and DDM valuation still indicate the upside compared to the model's market price. However, the analysis also showed that Kalbe future value is highly sensitive to margin assumptions. If cost of goods sold rises and remains high, the company's equity value should be significantly pressured. This is why API localization through LPI is strategically important. My final recommendation is proceed with the condition. First, Kalbe should proceed with the LPI joint venture because it has static M&A NPV and expanded NPV. Second, the company should maintain its target payout ratio of 55%, but remain flexible if margin pressures increase. Third, Kalbe should keep its capital structure conservative, with internal debt to equity below 0.15 during the ramp-up period. Fourth, with of average cost of capital of 9.7% should be used as the corporate hurdle rate. The key message is that Kalbe should not pursue aggressive expansion. Instead, the company should expand selectively using an options-based approach, like secure strategic rights first, and then test the feasibility, increase the commitment only after the risks are better controlled. This approach allows the Kalbe to protect its defensive profile while creating long-term value for shareholders. This is the end of my analysis. Thank you for the attention and goodbye.